Lots of great news in Nigeria as far as private sector entities taking the lead, as it should be. More private sector talk. Let's look at equity markets across the African nations that kicked off September yesterday. Nigeria is up 22 basis points. Ghana was down. South Africa down. Kenya up. Uganda up. Investment, if the NNPC is listed on the NGX, if the Dangote refinery gets on the NGX, if Sandos, Tinkan, you privatize those, put them on the NGX, which equity funds would invest in these entities? We had the Chief Investment Officer of Zrosk Investment Management. He joined us. That's Samson Esemuede of Zrosk Investment Management. Talk about a number of issues in the equity space and equity funds versus index funds. Great conversation.
We have to understand that emerging markets are driven by both external factors and internal factors. On the external side, what you have is a late cycle US market. And increasingly, as a consequence of that, the market is beginning to price in quite significant rate cuts in the US. So if you look at terminal rates in the US, 12 months out, it's at 3.5%. That is about 200 basis points of rate cuts that the market is currently pricing. Obviously, the impact of that is that you get weaker dollar, you get relatively strong EM currencies, and then EM risk assets performs positively, which includes equities and debt, right? Which is what we've seen in the market so far this year. In Africa, Africa has had its fair share of economic crises. We've seen significant level of currency adjustments. We've seen significant level of investor de-risking. So when you have positive external factors, very low level of ownership by institutional and local, foreign and local investors, it is not really surprising that African equity markets are doing well this year.
Fantastic. Any other appeal? Because, I mean, if you've got social upheaval in Kenya, you have high inflation in Nigeria, high inflation in Ghana. There was some political gridlock in South Africa. Despite all that, the markets still have appeal.
Yes, so market is an expectation machine. And so the question that I always ask myself is, what is the market expecting relative to what the market's, what the realized outcome in the market is? So if you look across Africa, South Africa, Kenya, and even Nigeria, what you have seen is a shift in the political environment. And although there's still significant level of risk involved in that, but the market tends to like change and tends to like reforms. And the noise around a lot of this country is about reforms. So when you combine reforms and you combine abysmal level of low level of ownership, I am not really surprised that the outlook for this market so far has been positive, and going forward, I think they should remain quite strong.
All right, now you've got a nice chart here. We've got some charts from Zrosk. That being said, I guess the foreign participation in Nigeria, close to 17-year lows. So, looking at that chart, what's the reason for that low foreign participation? Okay,
so there's two things, right? The stock of foreign investments in Nigeria, I'm talking about the ownership, foreign investor ownership of free float, as at 2014 was about 12 billion. That number as at June 2024 has gone down to about 2 billion.
Wow.
So there's been a significant level of selling. We know that since 2014, the economic environment has been very, very challenging with persistent level of devaluation. And for a long period of time, capital of foreign investors were trapped, given the closed exchange rate system that we used to run. So we've seen that level of de-risking, and that has also been mirrored by the level of foreign participation in the daily trading in the market. So when you look back, in the past, the daily trading in the market was dominated by foreign investors. I think they accounted for around 70% of the daily free floats. That number has now trended down to 20%.
Wow.
So the market today has changed structure somewhat from being foreign investor driven to being local investor driven.
Thank you for that. Now, I guess on the flip side, though, you do have another chart looking at portfolio investors, and there's a trend upwards for 2014. So talk about that.
For 2024.
2020. Look at me, I went back 10 years. Oh, 2024. Thank you. Yeah. So what's behind that? The reforms or what?
So it's a. I mean, the trend is trending in the right direction, but I would say the pace is not as aggressive as I would like, right? And most people would like. I think when you combine, like I said earlier, a low level of ownership and the reform conversations, right? We could argue, and I think we all agree as analysts, that the reforms haven't been well sequenced, and there's some question marks around the level of competency that has been brought to bear to execute the reform. It's very difficult to dispute the intentionality of the reform. And it's also very difficult to dispute the signs of macroeconomic normalization that we're seeing. So, for example, the short-term interest rate market is now anchored back to the MPC. The foreign exchange market has now, the spread that exists between the parallel market and the official market has narrowed. The fiscal revenue has gone from a low of 900 billion to over 2.3 trillion as at last month. And the part that is often not spoken much about is the underlying fundamental demand for dollars in the economy have declined. So if you look at the total quarterly numbers for imports of goods and services, we have gone from 17 billion or so to I think the last number was about 6 or 6.5 billion in terms of the importation of goods and services into the economy. These are fundamental drivers of dollar demand. So that reform is having an effect to an extent, and that has resulted, in my opinion, to a reduction in the volatility in the exchange rate. Not necessarily the absolute level, but the exchange rate is a lot less volatile, because within the exchange rate market, we've moved from dealing with an FX liquidity problem, which we had in December and January, to dealing with what I call a market structure price discovery challenge. The latter is much easier to solve relative to the former. And so that volatility has reduced significantly. And when you look at the latest data, there is evidence to suggest that inflation is starting to get re-anchored. So investors are seeing some of these green shoots of macro normalization, and I think that is what is driving the renewed interest in the markets, albeit the pace of that has been a lot slower than even our expectations.
Thanks for the breakdown. I want to get into some sectors now. Consumer goods. You have a chart where you look at the replacement cost, and you're seeing some value there. And I do want to get into this with you as to you helping us to explain what you're seeing with the consumer goods sector in Nigeria.
Okay. So the news around consumer goods have been very negative.
That's right.
I think we know what the top line pressures are, but more recently they've suffered significant FX-related losses. And some of the counters like Nestle are now even trading at negative equity. The point I wanted to make is people take this view that the consumer goods companies are bankrupt. Equity for consumer companies it's important, but it's not as important as it is for, say, a bank, right? So as an analyst, when you look at consumer companies, what you try to answer is that, does this business generate the cash flows that they require to meet their obligations to their suppliers, to their staff, to their debt holders, to their equity holders? And in most cases, for the consumer companies that are listed in the markets, the answer to that question is yes. The second part around the replacement cost chart, what we did there is a very crude assessment of replacement costs. We used 2019 as the base year, and given that the bulk of the capex that these banks spend are US dollars, we reflated the historic capex spend back to today's exchange rates, and we applied the depreciation over that period to get an assessment of what is the value that these businesses are worth if you want to recreate them today. And even with what we think is quite conservative valuation approach, we are seeing that these consumer companies are trading at deep discounts to the cost of replacing them. And when you look globally, consumer companies tend to trade at multiples of their replacement cost. And the reason is mainly twofold. First, consumer companies are branded companies, and brand equity is often not captured in the balance sheet of these businesses unless they've made acquisitions. And the second part, which I think is very important, that a huge part of an investment, of the investment that a consumer company make, is on route to market and distribution. And the route to market and distributions in these consumer companies are not captured in the balance sheet of these businesses. So when you look across global EM and across the globe, you would see that these branded consumer companies are trading at multiples of their replacement cost. Nigeria is quite unique in the perspective that a lot of businesses and household branded consumer companies like Nestle, like Unilever, like Dank Sugar are trading at deep discounts to what we think are conservative estimates of replacement cost.
Fantastic. You guys are doing the work at Zrosk, eh? Okay, so wait. If I throw back to you some of the consumer goods firms that have left and then the existing headwinds, inflation, shrinkflation to try to counter that, shrinking disposable income of the average Nigerian consumer. Well, what's your response to that?
So, my argument is not that the economic environment is not challenging. The economic environment is very challenging. You're seeing a lot of down trading, right? The argument, and then you're seeing a lot of consumer companies exit the market. I want to make one point, Rochester.
Yeah.
I think the exit of consumer companies from the market is a function of two things, right? The first is on what you mentioned, difficult economic environment. But I actually think generally Western multinational consumer companies have lost competitiveness on the continent. And they've lost that competitiveness to the Turks, they've lost that competitiveness to the Chinese, they've lost that competitiveness to the Indians, and they've lost that competitiveness to even indigenous players. So you can see like Right Foods and Biggie, you can see what Hayat Kimia is doing in the market. And the indigenous and the Eastern multinational companies are bringing an added level of efficiency that is just very difficult for the multinational companies to replicate, which is why I think you've seen the exits of the likes of GSK, you've seen the exits of the other consumer companies. So that's the point I wanted to make. And that creates a unique opportunity, and I think you're going to see an acceleration in that trend. So yes, the market is challenging, but I also think the lack of competitiveness is what is contributing to this rapid exiting and de-risking from Africa for Western multinational companies.
All right, hey, Samson, you make a good argument there. Let me move to oil and gas. Oil and gas headlines have been all over the place recently. I want to get your thoughts on some things, but first, you've got a couple charts here on Seplat and why you are bullish about the company. So here you said the Seplat market cap more than double. This is, of course, on the MPNU, which hasn't gone through yet, but the government has given indications that should clear. So talk to us about why you're bullish.
Okay, so we just talked about crises, right? As far as, for me, Nigeria is concerned, one of the medium-term ways to address our balance of payments situation and our fiscal situation is to increase the volume of onshore and nearshore production. Okay. Because the fiscal terms on onshore and nearshore is very attractive. Incidentally, a lot of these assets are being transferred into indigenous hands. So Oando, Ajip, Chapal, Total, and Seplat MNPU, right? The jury is out if these local indigenous players will go down the Venezuela route or they're going to be able to raise production. I'm confident with Seplat largely on three pillars, right? One is that they have a track record of growing marginal field production. Two, they have access to the London market and can raise significant level of capital. And three, they have a sound management team. When it comes to the MNPU transaction, you may ask what is unique about the transaction. This transaction has the capacity to triple Seplat's current production, double their current reserve base, and this field is rumored to have gas reserves that can be transformational for the company. And what I find really interesting about this business is while the rest of the indigenous players will need to go to their shareholders to raise equity to consummate these transactions, Seplat do not need to raise equity from their shareholders. They can fund this acquisition from their internally generated cash flow, which means that this acquisition, when it closes, is going to be accretive from day one,
Gotcha.
right? And then this transaction was announced in February 2022 for 1.2 billion at the time. But what is often missed is that there is also a lockbox structure. And that lockbox structure was supposed to sequester the free cash flow from that asset, and that free cash flow was going to be deducted from the acquisition cost at the time when the transaction closes. And we think that given the length of time that have passed, when the transaction details finally gets disclosed, there will be a significant ratchet down in the price that Seplat has paid for this asset. So acquiring a transformational asset for Seplat without diluting shareholders at this price is one of the reasons why we at Zrosk Investment Management are quite positive for the outlook for that company in particular, and we have a cautiously optimistic outlook for the sector in general.
I was going to ask you about NNPC, but we're running out of time, so let me skip that. Let me get to your fund. Let me round off your fund. The Magna Equity Fund. Yeah. Tell us about that equity fund.
So the Magna Equity Fund is a function of the opportunities that we see in the local market. My background is emerging market sales and trading. And over that 12 plus years that I have spent in emerging market sales and trading, I've seen a lot of crises. And crises for me creates huge opportunities for investors, even though they're usually quite painful for citizens. When I look at the value that is in the listed equity space in Nigeria today, they offer venture type return outlook with much lower level of risk. When you invest in venture, you take a uncomfortable view that a significant number of the investments in your portfolio are going to be worth zero. When you invest in the listed space, these are mature companies with assets, and through fundamental research, you can reduce the probability of ruin. And having that low level probability of ruin with a return outlook that can deliver 3 to 5 to 10x over the next 5 years is one of the reasons that have informed our decision to launch the Magna Equity Fund.
Why would I invest in that fund as opposed to just buying an index that tracks the all-share index or tracks other indexes?
That is a good question. What we are doing at Zrosk is isolating what I call idiosyncratic risk. My team, and that is largely as a result of, we think that there is significant level of strategic moat and competitive advantage that the best and well-run companies in Nigeria have. What we're trying to do as Zrosk is to capture that. If I invest in a basket of securities, I would deliver the market return. I think there are a couple of really well-run businesses that have been battered by the macroeconomic environment, that once we see macroeconomic stabilization, these businesses are going to compound returns and compound return on invested capital and growth, which will feed into share price appreciation and the dividend outlook. So what we are committing to via the Zrosk Magna Equity Fund is the ability to outperform the market on a sustained basis. Hence why we are running an active, concentrated, idiosyncratic risk isolation portfolios versus just buying a basket of stocks in the market.